Good morning, friends. Hey, it's about 8 o'clock. I just dropped the kids off at school. Today is January 15th, Wednesday. I just want to let you know that today's going to be a great day for mortgage rates. Why is that? Well, mortgages they're not tied to the Fed. You know, anytime you hear in the news what the Fed's doing to the federal funds rate, ignore that. As it pertains to mortgages, there's no correlation there, really. What the mortgage rates are correlated to is the 10-year Treasury bond, right? Because that's mortgages are a long-term debt obligation, and that's kind of what the 10-year Treasury index is. It's kind of a medium to longer-term bond, and when there's movement in the 10-year Treasury index, you can expect a movement in the same direction on the 30-year mortgage. Actually, all mortgages, but I always look at the 30-year conventional fixed rate mortgage. So why are we seeing this positive movement today in the 10-year Treasury? Well, every single month, there are key economic indicators that are released that tells us what the performance has been in that indicator month over month and year over year. And every month they're releasing a bunch of different core economic indicators, such as like payrolls, unemployment, job growth, producer price index, consumer price index, and core inflation. Core inflation was the one that was released this morning. So every month there is an expectation of what we're going to see for the next month. And so the good news this morning was that we're still seeing like a rise in inflation, right? Actually, I take that back. We're still seeing some inflation. It's just that it was better than the expectation was, right? So inflation rose slightly less than what they expected. So that's good news. And good news breeds confidence and optimism for investors to invest. And when I say investors, I'm talking about people that buy the mortgages, buy the long-term debt obligations. And so we're talking about large banks, pension funds, hedge funds, sovereign wealth funds, even countries buy United States Treasuries. And so when there's optimism, that creates demand. And so when there's high demand, prices of securities go up and the yields come down, right? Because if things are looking good for the future economy, that implies less risk. And when there's lower risk, there's lower rates. The yields don't have to be high because there's confidence. If the future is looking pretty dicey, like it's going to be a high risk environment, the way it's been the last 4 years with all the inflation that we've seen, interest rates have to come up because there has to be incentive to compensate for that risk, right? For these investors to invest their money. So anyway, better than expected news for core inflation today is driving the 10-year Treasury index lower by 13 basis points last I looked. And so what can we expect for mortgage rates today? Yesterday, the 30-year fixed rate conventional mortgage closed the market at like 7.25%. I'm guessing we'll probably see movement down to like 7.1 or 7.15. Maybe it's better, maybe it's not that good. I don't know. I'll post a little video later to kind of see where we closed and see if my predictions were like somewhat accurate. But anyway, so if the rest of the key economic indicators, if the reporting on that, for the rest of the month and for, into next month, if those are also better than expected, we're going to see a large boost in optimism and confidence in those markets. And what that will mean is we'll see a gradual reduction in yields and interest rates. And this is why I've been ringing that bell for weeks now. Like, hey, if you've been on the sidelines waiting to enter the market as a buyer or seller of real estate, you need to be getting ready right now. Like, you need to be talking to your real estate agent and you need to be talking to your lender, because you need to be ready to strike when that iron's hot. Like, if we work back down in the next month or so, 6 weeks, whatever, back down to low sixes, you need to capitalize on that opportunity, because we saw that in July, and the Fed, dropped the federal rates fund 3 times since September for a total of 1%, so 100 basis points. And in that time that the Fed has dropped 1% on the federal funds rate, we've seen mortgage rates rise by greater than 100 basis points. So greater than 1% rise in mortgage rates in the same time that the Fed has dropped 1%. So if we get back down to the low to mid sixes, I think, like, if you've been waiting, I think now's the time to get ready. And when we get there, that's when you need to strike. That's when you need to, and for sellers out there, you probably need to have your house on the market now. If you've been waiting to do it, you've been kicking the can, you need to have it on the market now, because you need to be ready to capitalize on those opportunities when the buyers are like, okay, now it's time to make an offer. So anyway, 6 minute, almost 7 minute video. I'm going to cut this one here. If you have any questions on West Valley real estate, you're thinking about buying, thinking about selling, or you have questions about, anything I just discussed, or you want to tell me I'm wrong, give me a call, shoot me a text, 602-295-0890. You can also shoot me a message or leave me a comment on this post. Yeah, so, and if you have like a scenario or like a situation where you're like, well, hey, like, is this the right time? Or I have some challenges with maybe getting ready to buy a house, or getting my house on the market, or whatever, unique scenarios, and you want to kind of get a fresh perspective on it, or just kind of chat, let me know. Happy to chat, happy to take the time and see if I can help you problem solve. Anyway, once again, Harvey Keene, Keene Properties LLC, Goodyear, Arizona, 602-295-0890. You can also find my website, www.soldbykeene.com. Thank you very much. Have a wonderful Wednesday.